some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated.
So that right there is Warren Buffett, the $100 billion man who is the best investor on the planet today. In 1965, Buffett purchased Berkshire Hathaway, which would go on to be an amazing success story and solidify his legacy. Berkshire went on to outperform the S&P 500, providing a compounded annual gain of 20.1% per year, which is double that of the S&P 500. Cumulatively, over the past 57 years, that's resulted in total gains of 3.6 million%. But how did Warren Buffett pull off one of the best long-term returns of any portfolio of all time? Well, it's through a very simple set of rules. No matter what the market conditions are, these rules never ever change.
I was genetically blessed with a certain wiring that's very useful in a highly developed market system where there's lots of chips on the table, and I happen to be good at that game. Ted Williams wrote a book called The Science of Hitting, and in it he had a picture of himself at bat and the strike zone broken into, I think, 77 squares. And he said if he waited for the pitch that was really in a sweet spot, he would bat 400, and if he had to swing at something on the lower corner, he would probably bat 235. And in investing, I'm in a no-called strike business, which is the best business you can be in. I can look at 1,000 different companies, and I don't have to be right on every one of them, or even 50 of them. So I can pick the ball I want to hit. And the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing you bum, ignore them. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. Over the years, you develop a lot of filters. And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle.
So you have to know what your edge is, know what your speciality is, and only invest into those companies that sit within your circle of competence. There are thousands of different publicly listed companies that you can invest into, and it would be completely unreasonable to think that you would have to know everything about every single one of those companies. Instead, all you truly need to understand is just a handful of stocks in depth.
If you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money, and I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea.
So big opportunities have to be seized, and you don't need too many of those opportunities in order to make an absolute fortune. Select your investments carefully but thoughtfully, because quality is better than quantity every single time.
I look to the business to determine whether I've made a good investment, and I'm concerned about whether we have new competition, how we do over the years, but it's the business I look at. When you're just looking at the price of something, you're not investing.
Remember, when you're investing, you're not just buying into a price of a stock which moves around in value. Instead, you're actually buying and acquiring a very small part of a business. That's why it's really, really important not to focus on the price of the stock, but to focus on the underlying fundamentals of that business instead. And all of this was underpinned in a line of commentary which Warren Buffett provided in his most recent annual shareholder letter. It states, "Whatever our form of ownership, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based upon our expectations about their long-term business performance, and not because we view them as vehicles for timely market moves." And that point is crucial. Charlie and I are not stock pickers, we are business pickers. So these 6 key investing principles are what Warren Buffett has followed throughout his investing lifetime. It doesn't matter whether you watch an interview from the 1960s, the 1990s, or the 2020s. His approach has never changed. But as we all know, we're now facing into some very challenging times ahead. And as a result, stock market returns might not be as easy to come by now as they have been in the past. We've got overvalued stock markets, inflation running hot, interest rate hikes on the cards, along with extreme geopolitical tensions too. So let's take a listen to Warren Buffett's advice on these 4 key factors to see how we can come out on top. starting with overvalued markets. So despite the fact the S&P 500 is trading down 10% from all-time highs, the Shiller price to earnings ratio still certainly suggests we're in overvalued market territory. It is without doubt one of the most common concerns amongst investors right now, because none of us want to pay more for something than what it's actually worth, let alone pay more for what the future value is too. But interestingly enough, overvalued markets have always been a concern for investors. Dating all the way back to Berkshire's 1998 annual shareholder meeting, Buffett had this to say.
The general market is not overvalued if two conditions are met, which is, in our view, which is that interest rates remain at or near present levels or go lower, and that corporate profitability in the U.S. stay at the present or close to the present levels, which are virtually unprecedented.
So let's not focus on interest rates for the moment, because we'll focus on that in just a couple of seconds time. Instead, let's just solely focus on the point around corporate profitability. Back in 1998, when Buffett said this, the S&P 500 earnings per share was $39.54. when the S&P 500 traded under 1,000 points. However, since then you can see the direct correlation between the earnings per share and the value of the S&P 500. And over time, as you can see, corporate profitability of the broader index always goes up, and therefore the price of the index goes up too. So whilst the market might feel like it's trading a little bit hot right now in overvalued territory, you don't always have to focus too much on whether the market is overvalued today, because in 10 or 20 years from now, current prices today may look very cheap. Investors thought the market was overvalued back in 1998. However, since then the market has over tripled in value. So certainly focus more on the long term, because providing we've still got healthy levels of inflation, and as long as corporate profitability still is rising, then technically the value of your investments should still be rising too. So the next challenge for investors is inflation. It's been one of the headline stories for 2022 so far, as you'd probably expect, because inflation is running at multi-decade highs at 7.5%. And as we all know, when inflation is running hot, it reduces the purchasing power of every single dollar in which a company has, and therefore the future cash flows that a business is expected to generate is now worth significantly less. But historically and periodically, inflation does run hot. It is just part and parcel of different economic cycles. So Warren Buffett, a man who has quite literally seen it all, what businesses should we be looking to invest into when inflation is running high?
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth, and that have strong positions that allow them to increase prices with inflation.
Now that was Warren Buffett talking at the 2011 annual shareholder meeting, when at the time inflation had just risen 500 basis points, rising from -2% after the financial crisis right the way up to 3%, which is just a little bit higher than what you'd probably consider as a healthy level of inflation. Regardless, when inflation goes up, Buffett says you should invest into companies who require little capital investment to facilitate inflationary growth. So here Buffett is talking about companies that can still generate cash without spending or investing a lot in order to make that happen. Or in other words, stocks that have hugely scalable business models. Think about a stock like Alphabet, also known as Google. If they wanted to continue to grow their business, they wouldn't have to go on and build a whole new Google search engine, or perhaps even a new video platform like YouTube, and instead they could simply just increase the frequency of the ads in which you see, or perhaps even the price of those ads in which you see, in order to continue to scale their business. Now the second key point that Buffett also said is that you should invest into stocks who have strong positions that allow them to increase their prices with inflation. So here Warren Buffett is talking about the stocks who have something called pricing power, which is the ability for a business to still increase prices without a material difference to the demand for their products. Let's take Apple as an example. If they go on to increase the price of the next iPhone when they go on to release it just in line with inflation, the chances are Apple customers will still go on to buy that new iPhone. I don't know about you guys, but I've never ever seen an empty Apple store, and that's despite the fact that they still sell many of their products at absolutely extortionate prices. prices. The same kind of philosophy goes for companies like Coca-Cola. If Coca-Cola just increased the price of their servings by 1 cent, that's an additional $19 million in revenue generated per day, which is the equivalent to $6.9 billion in revenue per year. And that's just from increasing the price of one serving of Coca-Cola by 1 cent. And it probably comes as no surprise that both Apple and Coca-Cola make up two of the biggest holdings within Warren Buffett's investment portfolio. The next challenge which we have on our hands is the potential for rising interest rates. Warren Buffett once said, interest rates are like gravity on stock prices. When interest rates are so low, stock prices inevitably are going to climb, which has obviously been fantastic for us because interest rates have been pretty much flat for the best part of the past decade. One of the primary reasons for stock prices going so high is the fact that when interest rates are low, bond yields are also low too. And as a result, money managers who would usually put a lot of client funds into bonds practically have no other choice but to invest in equities instead in order to get a return on investment. And that's pretty much the reason why we've seen unprecedented stock price growth in the past 18 months. But now we're heading in the other direction, with rates about to rise and therefore the gravity effect not taking place as much. And therefore, with interest rates going up, stock prices are likely to fall. You may have seen plenty of news headlines stating that the market is already pricing in future rate hikes, and we can already see the effect that's having on the stock market so far in 2022. This will likely be just part and parcel of another economic cycle where your more conservative companies that are cash rich will probably outperform some of your more speculative growth stocks. So that's certainly something to bear in mind. Then finally, we have the geopolitical issues that we've more recently seen between Russia and Ukraine. Whenever war or conflict breaks out, it certainly has a ripple effect on financial markets, especially in the short term. As a result, it can raise concerns amongst investors on what assets we're holding, which ones we should be looking to buy into, along with which ones we should potentially be looking to sell, along with also thinking about the overall exposure on our investment portfolios. So with that in mind, here's some advice from Warren Buffett on the best possible investment you can make.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore.
So Warren Buffett and historical data tells us that we shouldn't get too hung up on the short-term impacts on the stock market based on geopolitical events or even any external factor for that matter. Because as Buffett says, in economics you always have to ask yourself, and then what? Because when you're investing, nothing is ever constant. Variables are always changing and market conditions are always moving. So the best thing that you can do is to buy into good quality companies at a fair price and hold it out for the long term. It really is as simple as that. And if you're not too sure what individual stocks to invest in, then simply pick up a whole index fund. So with that said guys, if you do want to learn a little bit more about how I personally put my investment portfolio together, then be sure to click on this video here. As well guys, before you go, if you did enjoy this video, be sure to drop a like on it. It really helps out the channel. As well, subscribe if you're new around here. And with that being said, I'll see you over in the next video.